Perfect. So I am joined today, very special guest, Michelle Tiraborelli from Brompton Funds, one of my favorite fund managers. And today we're going to talk all about the closed-end funds or the split funds, right? Split funds or closed-end funds. So Michelle, thanks so much for joining me today. I have a lot of questions for you. So I feel bad for you a little bit, but not really, but we'll go through them. We'll go through them one by one. Thanks so much for joining.
Yeah, thanks for having me.
All right, so let's get started right away. Let's not waste time. So Brompton is one of the largest providers of split share funds in Canada, also known as split corporations. Split funds are fairly complicated investment product. I know I have trouble explaining them sometimes. I have a 1-hour video trying to explain them, and even then I probably could have done a better job. But in November 2005 is when you guys launched your first split share fund, SBC, right? The one that has the big 6 banks. So my first question, why were split share funds created in the first place?
Yeah, well, split share funds were originally created as a way for investors to get enhanced returns on a portfolio of stocks. The early split share funds invested in simple portfolios of commonly held stocks like the big 6 banks, and the investments wouldn't change. But the idea was, if you're going to be invested in the banks anyway because you believe it was a good investment over time, why not do it in a way that can enhance your returns? Now, over time, split share funds have evolved. Today, investors have many more options covering a variety of sectors and more diversified portfolios. But the idea is the same in that the structure provides investors in the Class A shares with a simple way to get enhanced exposure to the returns of the portfolio.
Right, and that brings me to my second question. We know split share funds are called split because there's 2 classes of shares, right? The preferred shares and the Class A shares, aka the capital share. So what is the difference between these 2 classes of shares?
Right. So split share funds typically invest in a portfolio of dividend-paying stocks, which I'm sure you've explained to your viewers, and then they issue 2 types of shares to investors: a preferred share and a Class A share. You can think of the preferred shares as being the debt of the fund, and the Class A shares as the equity.
Okay.
The preferred shares are typically issued at $10, and the preferred shareholders have a priority claim to receive $10 at maturity, as well as quarterly dividends over the term. But the preferred shareholders do not participate in the capital appreciation of the portfolio. All of the growth goes to the Class A shares, and this is how Class A shares get enhanced exposure to the returns of the portfolio. The preferred shares are more conservative. They're suitable for income-focused investors who want stable returns.
Right.
The Class A shares, on the other hand, can be attractive for investors who are looking for higher total returns and monthly distributions. The Class A shares are more suitable for investors who are comfortable with the risk that comes with investing in equities and want to invest in a particular sector or market for upside potential.
Right. Okay, perfect. You mentioned maturity date. We'll talk about that a little later. Before that, I just want to ask you about the management fees. So how do management fees actually work on this split share structure? From what I've seen and looked at and read, it seems that for both classes of shares, the responsibility of the management fees actually entirely on the Class A shareholder, not the preferred shares. Do I have that correct?
Yeah, so there's one management fee overall for the fund. And yes, you can see that the Class A shares cover this fee because remember, the preferred shares are designed to get back the original $10 at maturity, along with the quarterly dividends over the term. All of the remaining assets of the fund, net of fees and expenses, goes to the Class A shares.
Okay. Okay, perfect. And by the way, you have a really, I told Chris this as well, you have a really nice website, one of the best of all the fund managers that I've seen. You have all the details of the funds, the dates, inception date, performance. Can you just confirm that in the performance tab, which is basically when you look at the annual compound return data, all this is net of fees? Can you confirm that?
That's right. Yeah. So the performance is net of fees. The returns are based on the net asset value of the shares. And
okay. Yeah, not the market price.
Right. That's right. Okay. The net asset value. And the returns assume that distributions are reinvested into additional shares. This is the standard method by which fund companies have to report fund performance.
Yeah, it's just something I wanted to confirm with, an official, representative from a fund manager. I get questions all the time about this, about the fees. So the income, it's already net of fees. It's the fees are I explain it like it's already included in the fund. So it's nice that you basically just confirm that. So now let's get into the good stuff, or I like to call the good stuff. The 3 biggest concerns, the 3 biggest questions or confusion I get about split share funds are the termination dates you call the maturity date, overnight offerings and that $15 unit NAV rule, where the unit NAV, which is the net asset value of the Class A shares and the preferred shares, has to be above $15 for the Class A shares to get the dividend for that month. So let's go over these three concerns or questions. I'm sure you get them all the time. So
Sure.
what are overnight offerings? Let's start with overnight offerings. And the biggest question I get about them is, does it dilute the net asset value or the value of the fund? So let's start with those.
Okay, so overnight offerings are a way for the fund to issue new shares to investors, and it can increase the overall size of the fund. These offerings are not dilutive to the NAV of the fund. Whenever we do an offering, the shares have to be priced at a level where the net proceeds will not be less than the NAV. And because the shares are always issued at a premium to NAV,
right,
the offerings are often accretive, which means they can help increase the NAV. And as the fund grows larger from overnight offerings, this can also increase the trading liquidity of the shares and can reduce costs because you're spreading some fixed expenses over a larger base of shareholders.
That's great. That's exactly what another split fund manager told me as well. So it's really good news because because you're actually offering the shares at a higher price than the NAV. That's and correct me if I'm wrong. You're actually not allowed to offer them at a lower price of the NAV. Is that correct? So automatically, it's a good thing for the fund. So it increases the value, like you said, it makes it bigger, so better liquidity. So essentially, it is a good thing. Overnight offerings, and we know that you guys have to do overnight offerings to issue more shares because this is a closed-end fund, which means there's a set number of shares, and it's not like an ETF, which is an open-ended fund where they constantly redeem the shares and create new shares. So thanks for confirming that. Really appreciate it. Let's talk about that $15 unit NAV rule. This is a question I've been looking forward to. So it seems that most split funds, not just the Brompton ones, but almost all of them, have this rule where the unit NAV has to be $15 or more for the Class A shareholder to get their monthly dividend. So why is this rule in place?
Yeah, well, this rule is in place basically to protect capital in the fund. You may see the unit NAV drop below $15 for a period of time when the broader market or sectors that the fund invests in experience a drawdown. And it can be unsustainable to continue to pay out a very high dividend in that situation. So when that happens, Class A share distributions will be suspended for a period of time until the NAV builds back up again. The Class A share distributions are announced on a monthly basis. So every month when it's time to announce the distribution, there's a test to see if the unit NAV will be at least $15 after paying the distributions. If it is, then a distribution will be announced for that month. But if not, no distribution is paid that month, but it's reassessed again the following month.
Okay, perfect. That makes me extremely happy what you just said, because the way I try to usually explain it to people who have trouble with this, because they fear missing dividends, is it's kind of like a fail safe to protect the fund long term. You kind of said to protect the capital. So I'm actually glad you said that. It means I was right. I took a guess there, but after thinking about it a long time, you kind of say, hey, these funds have been around for a really long time. So maybe this rule, even though I'm missing dividends once in a while, if the overall market's not doing well, it's probably a good thing to preserve the fund, to preserve the capital long term. So thanks for that. Appreciate it. What about maturity dates or termination dates? Now, I've dealt with this issue before, and for me, it's not really an issue. I know that it has pretty much entirely to do with the preferred shares. So can you explain very quickly why these split share funds have maturity dates, or AKA termination dates? Should investors be worried about that?
Well, no, this is not something investors need to worry about. Split share funds have a maturity date, but this doesn't mean that the fund will terminate on that date. The reason why split share funds have a maturity date is to give a set term to the preferred shares. Split preferreds are often issued with a 5-year term, and they have a set dividend rate for the term. So as the maturity date approaches, the company will typically announce an extension of the term for another period of up to 5 years and sets a new dividend rate for the preferred share for that next term. Some of Brompton's split share funds date back to 2005, 2006. So these funds have gone through multiple 5-year terms without being terminated.
Yeah, I've actually never seen a split share fund that got terminated because of that, hitting that. So basically, essentially, you intend to have the fund go on as long as possible. You have no intention of actually terminating it or closing it, right? You're always it's because of that preferred share, because it works kind of like a bond, like you said, right?
Yeah, that's right. And investment funds in general could potentially be wound up for certain reasons, like if the fund's too small to operate
Too small.
efficiently. But that's true for all types of investment funds, even if
Right.
they don't have a termination date. And one other thing I can add is that having a set term is an attractive feature for shareholders because one, preferred shares have their dividends reset for the new term. So that means in a rising rate environment, there's an opportunity to have their dividends reset higher.
Increased,
And
yeah.
and also both preferred and Class A shareholders have the option to redeem their shares at the maturity date, even if the terms extended.
Okay, is that the retraction, the annual retraction feature? Okay, I actually got a question for that a few days ago. What's the annual retraction? Some funds call it the annual redemption feature. I've heard several terms of it. That's if you want to basically hand back in your shares for a certain price, I'm assuming, right?
That's right, and the retraction options are based on the net asset value of the fund. So with split share funds, we often see the Class A shares and the preferred shares trade at premiums to the net asset value. So often investors, if they're looking to exit their position, are a lot of times better off selling in the market. They can get a better price than if they tender to the redemption, but that option is there.
That option is there. Yeah, I get the question all the time. What should I do? Should I do something, Adrian? I say, you know what? Don't do anything. Don't worry about it. That's usually the best thing. Okay, perfect. Just in case, let's just say out of the blue, a fund does terminate at the termination date. What happens? I know that the preferred shareholders are returned that initial $10. That the preferred shareholders are the ones that have the downside protection. What happens if you're a Class A shareholder and the fund terminates?
Yeah, so all the assets of the fund, net of like the preferred share value. So the preferred shareholders, entitled to receive $10 plus any accrued distributions owing to them, and everything else is goes to the Class A shares on the wind up of the company.
Right. So if you're a Class A shareholder, whatever the NAV is, once the preferred shareholders are taken care of, you get that back. It's not like it goes to zero and you lose all your money, because I've actually gotten that question before. That's not the case, right?
Right.
Okay, perfect. Glad you could clear that up. So let's go back to that very quickly, that $15 unit NAV rule. So let's just take an example. I'm taking an example of LBS here. In 2020, during that sharp COVID crash, it missed about 8 dividends in a row. I'm talking about the Class A shareholders, shares. So when any split fund Class A is starting to miss dividends, either whether it's 1 month or 2 months or 3 months, is the fund still making money, still generating dividends and covered calls, dividends, things like that? My assumption is yes, but if you could confirm it, that would be great.
Yeah, so even if the Class A distribution is missed, the fund can be earning income from covered call writing and dividends. And Class A shareholders will still benefit from this because any income earned from covered call writing or excess dividend income will help grow the NAV. And then eventually the NAV builds up above the $15 threshold, will start paying dividends again.
I'm so happy I'm doing this interview with you, because it's just confirming what I usually say, right? So even if you're missing dividends, this is how I explain it to people. There's no reason to panic, because the fund is still generating dividends, it's still writing the cover calls. It's going to help rebuild the NAV back over $15. So you start paying the dividend. So this is why that rule is kind of, I call it a fail safe, right? Like we talked about earlier. So thanks for talking about that. That's really, really useful, and I'm sure people will be happy. So one of the biggest complaints, and I'm sure you probably get this as well for split funds, and I'm really talking about the Class A shares here, is that there's barely any growth in terms of stock price. It even seems for some funds that the NAV is or the stock price is deteriorating over time. So how would you respond to that claim or that concern? Because it's definitely the biggest one I usually get.
Yeah, okay. So the income is a very important part of the return. So investors shouldn't be ignoring that, especially for split Class A shares, which pay very high distributions. So when you factor in the distributions, you see that over the long term, Class A shares of Brompton Split Corps have outperformed their benchmarks. We actually published a report on this last year, which is available on the Brompton website. I also like to remind investors that if they're only looking for growth and don't need the monthly income, they can participate in the fund's dividend reinvestment plan.
Right.
We'll reinvest the monthly distribution into additional Class A shares on a commission-free basis.
Yeah, and because these funds are leveraged, they're synthetically leveraged because of the structure of the share. The annual performance compound returns is actually very impressive. A lot of people don't go and look, but for example, there's DGS, there's LBS, there's SBC. They have very, very high annual compound total returns on average, beating the overall market by a long shot. So it's like you said, and this is what I always tell people, you're just looking at the stock chart. That's literally half the story for these types of products. You have to factor in the income. If you factor in the income, like you said, even if you don't need it, if you drip it, you're getting just as much growth as, probably even more growth than the overall market anyway. That's why I love these funds. And I typically say, and tell me what you think about this, a growth strategy cannot be turned into an income strategy, but the income stuff can be turned into a growth strategy like that by turning on the drip. What do you think of that?
Sure. Yeah, no, I agree.
Yeah, perfect. Awesome. So let me see this. What's the next question I have here? So your biggest competitor when it comes to split share funds is probably Quadravest, right? So what would you say that Brompton does differently than Quadravest? Why would somebody choose Brompton over Quadravest for split funds?
Well, I mean, at Brompton, we aim to provide investors with a lot of resources to help them make informed investment decisions. So, we post weekly or daily NAVs, monthly performance, regular portfolio updates, and commentary from our portfolio managers. And we also have a team here that's always available to take calls or emails directly from investors to answer questions they have about our funds or help them find information they're looking for. So we like to provide that service to investors to help them with their investment decisions. And in terms of product offerings, Brompton does offer some unique split share funds like Global Dividend Growth Split Corp and newer one, Sustainable Power and Infrastructure Split Corp. And this is in addition to the more common types of split share funds we typically see focused on financials or Canadian equities. And then we also offer a lineup of exchange traded funds that all pay monthly distributions and provide even more options for investors.
Yeah, honestly, I have to agree with everything you said. Your website, even comparing with Quadravest, so much nicer and better. And you guys do come out with the articles I've read. You just came out with a recent one talking about preferred shares specifically. So really, really good articles, really nice website. Your unit NAVs are updated minimum once a week. I noticed some are updated like the GDV and the PWI, the newer ones, pretty much daily. Quadravest, it's like every 2 weeks or every 3 weeks. So I definitely have to agree with everything you have said there. So let's talk about a little bit about the specific split funds. Very excited about this. So it seems like one of the most popular split share funds in Canada overall is doing it on the 6 big banks, right? You have SBC, there's the Premium Income Corporation, there's BK from Quadravest, there's all kinds. It seems like it was one of the first where it's a very common set of stocks to do a split share fund. So why are the Canadian banks such a great candidate or very popular to do a split share fund structure on?
Yeah, well, the Canadian banks are a great candidate for a split share structure. First reason is they have a high dividend yields and a history of growing dividends over time, which provides a high level of income for the portfolio. And secondly, they've been an excellent investment over time. I was looking at the returns, and on average, the big 6 Canadian banks have returned 13% per year over the last 10 years.
Yeah, they're legendary, right? I mean, I call them the legends of the Canadian stock market. Sorry, go ahead.
Yeah, and that's more than the TSX index has returned, about almost 4% more a year. So, and these numbers are to the end of May. But so it's this combination of high dividends and long-term growth that make the Canadian banks a great option for a split share portfolio.
Yeah, makes sense. And focusing on the Canadian banks still, you guys have SBC. That's your Canadian banks split fund. So they've been doing really, really well. And because of growth and the increasing dividends of the 6 banks, back in December 2021, you guys decided to give investors 25% additional shares for free, right? So you had, I guess, another split share provider, Quadravest, increased the dividend or the distribution. You guys, left it at 10 cents a month or $1.20 annually, but you gave investors 25% free shares, basically. So what made you guys come to this decision?
Right. So the SBC share split accomplished 2 things. First, Class A shareholders got a 25% increase in their distributions. And secondly, it also provided Class A shareholders with more upside potential by adjusting the NAV per share. So in the share split, Class A share investors received an extra 25 shares for every 100 shares they held.
Yeah.
So now they're getting monthly dividends on the additional shares as well, which boosts their income by 25%. And the other thing that happens in the share split is that the NAV per share is adjusted on a per share basis, adjusted lower because investors are getting additional shares. And because SBC had such strong performance, the Class A NAV had grown to well over $16 per share prior to the share split. And the higher the Class A NAV gets, the less enhanced return potential there is for the Class A shares. So in addition to increasing the distributions, the share split provided Class A shareholders with more growth potential as well.
Okay. Oh, that makes sense. Okay, cool. Yeah, I really like getting that, but it was really fun just logging back in, and all of a sudden I have a lot more shares, and next month's dividend, like you said, is 25% higher. So really, really cool. Let's talk about DGS. So DGS is, in terms of AUM, your biggest split share fund. So DGS is the Canadian dividend, basically has all the best Canadian dividend growth stocks, right? So like I said, it's your biggest fund. Would you say that this is a really great way for Canadian investors to get, exposure of some of the best or the best dividend stocks in Canada in a leveraged way?
Yeah, absolutely. So, DGS invests primarily in large cap Canadian dividend growth stocks, and we like investing in dividend growers because these are all stable companies that have done a really good job of growing earnings and cash flow. And over the long term, dividend growers have outperformed the broader market with lower volatility. So we think this is a great way to invest in the market and have a quality portfolio of dividend stocks focused on the Canadian market.
Yeah, that's good. I'm just looking on the website here, and it looks like they could be maybe a little bit behind, but it's over 10% annual compound return since inception, which basically means that if you count, like you said, the income as well, very important. You can't just look at the stock price. If you count the income and if you dripped it, you basically have 10% a year total return on this fund that's been around, I think, since 2007. So that's really says something about the split share funds, and that they do outperform the overall Canadian market. I mean, the overall Canadian market does not do 10% a year. Maybe the S&P 500 does, but that's for dispute. Usually they say 8 to 10%, but that just proves that, like you said, dividend stocks that grow their dividends over time tend to do much better with less volatility. So that's awesome. One of my favorite ones, so I want to talk about my favorite split fund that you guys have now. So SBC, LBS, they're fairly simple split funds, right? They focus on the Canadian financials and insurance sector, but you guys launched GDV back in 2018, which focuses on dividend growth stocks globally, all over the world. I mean, I always say this is my favorite split fund. So what's the premise, or what made you guys come up with this idea? And how do your fund managers choose the stocks? Because now we're really, you have a lot of dividend stocks to choose from, right? So let's start with, I guess, how did you guys, or why did you guys come up with this? And then we could talk about the stock selection.
Yeah, so for the same reasons we were just talking about with DGS, we believe investing in dividend growers is a great strategy. So Global Dividend Growth Split Corp invests in large cap global companies that are growing dividends. And another reason why we thought this would be a good option for investors is that by investing in global equities, you can get exposure to sectors that are not well represented in the Canadian market. These are sectors like healthcare and technology.
For sure. Yeah. And I really love the fund. I mean, I look at the portfolio, I click on portfolio there, and I just see like all the countries and all the sectors. It's not like your typical Canadian portfolio, which is like 40% financials, a lot of energy, utilities, materials. It has tech, it has healthcare, it even has real estate, consumer staples. It basically has everything. So I really, really love that fund. So a lot of stocks to choose from. And once in a while, I always stop by to see the portfolio composition, the stocks in there. And some of them are from Europe. I'm like, I never heard of this. I just grab it, I put in Google, and I'll see like chemical company in the Netherlands. And there's so many stocks to choose from. How do your fund managers choose the stocks that go in GDV?
Yeah, well, to start with, we only look at companies that have at least $10 billion market cap. So these are all big companies. And our portfolio managers choose companies to invest in by looking at various factors like dividend yield, the potential for dividend growth, what are the valuations like, earnings, etc. And they also look at macroeconomic conditions, fundamentals of certain sectors to decide how to allocate the portfolio across geographies and across sectors. And really the end result is coming up with a well-diversified portfolio of high-quality companies that are growing their dividends.
Yeah, I really like that fund. I tell everyone it's like you want to get the best dividend stocks all over the world. You have GDV in a leveraged way, and you guys also have I spoke about it with Chris. You guys have a covered call ETF that kind of does the same thing. It's global dividends. I think it's BDIV if I remember
That's
correctly.
right.
Right. So you have the option of the leveraged one, the non-leveraged one, if ever you don't want that leverage. So really, really cool funds. And speaking of unique and cool funds, PWI. This is the first ever ESG focused split fund that has a lot of infrastructure, utilities, green energy stocks. What made you guys come up with this? And again, how are the stocks selected?
So we launched PWI last year because we see that the demand for renewable energy and sustainable infrastructure is growing, and we think this presents an attractive opportunity for investors. A good growth opportunity that will last for many years. So we're seeing that countries around the world are now setting targets to reduce greenhouse gas emissions. They're looking to develop secure sources of energy, and also there's a need to replace aging infrastructure. So we're going to see trillions of dollars invested in the coming years to achieve this. And in PWI, we invest in companies that we believe will benefit from this trend. Our portfolio managers are really looking for quality dividend-paying companies that are involved in areas like renewable energy, energy efficiency, green transportation, as well as communications infrastructure. So those are the main areas that we invest in this fund.
Yeah, really cool fund. I really like it honestly because it's not pure green energy. You have infrastructure stuff, like you said, dividend companies. Bell is in there, TELUS is in there. So I really like it's not just green energy. It's just companies that are probably going to benefit long term of the renewable energy or whatever, the utilities as well. So really, really cool fund. And honestly, I kind of see that as a little theme in all your split funds, where you're a little bit more broader. Typically, you add a little something to make it, make a little special. For example, SBC, you have that North American ETF. In PWI, you have the infrastructure ETF. There's other examples that I'm running. Oh, DGS has, it's not, there's that ETF, the global ETF or something. So I really like, that I've noticed it, and I really like your funds because of that, because they're not like, there's always a little something that's apart from the main theme of, I think it adds diversification. I'm a big guy on diversification, get as much stuff as you can. So
exactly,
really, really cool.
Yeah.
I really like that.
Yeah, we find it's an efficient way to get some added diversification into the portfolio.
I like it. I like it. So, all right. So that's pretty much it for just maybe one or two last questions. I won't hold you up for much longer. So there are split funds, for example, where the Class A shares have stopped paying dividends for a long time or have stopped altogether. LCS is a perfect example. LCS is, it just has the 4 life insurance companies. It's not like LBS that has the 6 banks and the 4 life insurance companies. LCS is just the insurance companies. OSP is your oil split fund, which is just energy companies. So it seems like this happens rarely, but it seems like if a split fund is very, very, the more niche it is, the more risk it has as for the Class A shareholders to miss dividends and stuff like that. So what would be your comments on that as a whole? I know it's a weird question, but I typically refer to, or I think of it as the death of the Class A shares, and it only seems to happen on specific, really, really niche funds. So what would be your comments on that?
Well, it's a good observation. Split share funds that invest in a single stock or more concentrated portfolios in a single sector can have more risk in that regard. Right. So when you have a more diversified portfolio with a larger number of holdings or sectors, that can help mitigate the impact that a single stock or a sector can have on the overall returns of the portfolio.
Yeah, it makes total sense. And your OSP actually just passed $15 unit now. So it's been a long time, but now I'm assuming they're going to restart, right? The dividends on the Class A shares.
Yeah, so that's right. The Class A or the unit NAV has grown above $15 for OSP. So as we near the distribution announcement date for that, if that is still the case, then there will be a distribution announced for
Yeah, that's
OSP.
great. I had the reason why I went back and checked a few weeks ago. Someone messaged me and said, "Hey, I've been buying the oil split fund really, really, really cheap, and now he's super excited because he doubled or tripled his money." So the Class A shares are really, you could play around with them and you could capture some really crazy growth because of that leverage as well, right? But
Right.
like you said, diversification in terms of for income consistency, the more diversified something is, the better it is long term. That's basically the theme of for everything anyway, so it's no surprise. So you've been a great sport. I really appreciate your time. You answered a lot of my questions. I was very excited to finally speak to a legit, big split fund manager. So you're the second one. So thanks again. I really appreciate it. If you want to add anything, mention anything about Brompton, whatever you want, you could go ahead.
Yeah, no, I just want to thank you, Adrian. This is a great experience, and I love what you're doing with educating investors on this product, and encourage investors to check out the Brompton website, and we have
Yeah, really nice website. Really nice.
A lot of products beyond split share funds, including exchange traded funds, and we're always here to help answer questions that investors may have.
Well, thanks so much. Really appreciate it. And hopefully we'll do this again some other time. If you guys come out with a new fund, anything to do with income, I want to know about it. That is my bread and butter. So, I kind of have OCD in that way. I got to know all the Canadian funds out there that are designed for income. So I'll keep an eye on your stuff and hopefully we'll talk again soon. Thanks, Michelle. Really appreciate it.
Thank you.
Thanks for watching, everyone. Really appreciate it. Make sure to hit that like button, that thumbs up button. It helps the channel grow, so it's a win-win. Also, make sure to subscribe if you're not already subscribed, not to miss out on my future content. It's all about income-focused investing. And also, you got to be subscribed if you want to participate in my surveys where I ask the audience, I ask you what topic you want me to cover next. So very important. Subscribe, hit that little bell button so you are notified of any new videos and any new surveys as well. Make sure to check out our website. We have a website, passiveincomeinvesting.ca. That's where you could purchase my digital product that I'm very proud of, the ultimate DIY investing package, which is on version 3 right now. So this is a reference tool. It's a companion tool to help you build your own custom portfolio. It's good for Canadian investors and American investors. So it covers both the Canadian and American stock markets. It has sample portfolios as well, multiple sample portfolios for different investing styles. So it's a very cool product, and it does come with lifetime updates. So you only have to purchase it once. My intention is to come out with a new version every single year. So you purchase it once, you never have to pay for it ever again. You'll get the lifetime, the updates for free forever. Also, right there on my homepage on the website, I do offer a one-on-one coaching session. If ever you want a little more personalized help, it's a 1-hour Zoom call with yours truly, a one-on-one with me where you could ask me anything you want. We'll go through your situation and I'll give you my opinion on how best, I'll help you best I can, basically based on my opinions. Just keep in mind that I am not a licensed or registered financial advisor or financial planner. We also have a Facebook group, so join us there. Passive Income Investing, over 11,000 members. We try to get the spams and the scammers out of there as quickly as possible. So it's a very, very clean group. Everyone's asking questions, trying to help each other. And it's a really, really cool and fun community. If you want a little bit more personalized stuff on our day-to-day life, follow us on Instagram as well. We recently moved to Panama, so if you want some more information on more personal stuff, you could follow us on Instagram. My mission, the mission of this channel will always remain the same, everyone. It's to help everyday, regular, normal, working people to invest on their own, do-it-yourself investing, right? In order to build their own stream of passive income to enhance their quality of life and one day become financially free, financially independent. Very important goal. So as usual, continue to stay safe, everyone. Stay healthy and of course, stay passive. See you next time.